All right, let's start. So tonight's very important. We're going to start on paper 4. Actually, so what I want to do is walk through this template. We'll do a little bit of review of accounting, not too much. I'm somewhat disappointed that they actually added that easier accounting class for finance majors. I wish they had left it with the regular class. Like, finance majors should do better in accounting than accountants do. Accounting is pretty important. I've gotten a little more comfortable with it just because the accounting you're going to learn as a finance person is going to be very, very industry specific. And so I can kind of see that, but you need to know the accounting. We're going to do a high level on accounting tonight and then get right into the template. So what we'll probably do is after the accounting review is I'll walk through the template and then I'll do the first part of the template, which is liquidity. And liquidity is the hardest. And part of it's the hardest because the accounting classes corrupt you somewhat. So we have to undo some of that. But then what I want to do is as I hit a section like liquidity, I want to not go to the next section, but I want to go to my Walmart example. And that's why I want you to have your company's Excel spreadsheet open. So you can see what I'm doing with Walmart. You can see where I'm getting the numbers, where I'm getting the charts. And so we'll probably do it like that. I've tried it both ways where I go through all the material and then come back to Walmart. But if I do that, everybody forgets what I talked about on liquidity. So we're going to do it in that approach. So you should have that Excel file open for your company. And you should have the Walmart Word document open. And you are perfectly allowed to write paper 4 by just editing the Walmart and then making that your company paper. So this is the one time where the plagiarism check doesn't really help all that much because there's a lot of overlap in this paper. But I just got frustrated with the fact that students just somehow in finance, we're not giving y'all a good template. And so I want to give you a really good template to use. And it does work very, very well. So I'm going to the class notes. If you want to open the class notes as well, you can do that. I'm on page 13 of the class notes. I want to do a real quick review of accounting. So we're going to be using GAAP financial statements accountings. However, what I actually put in the spreadsheets that I built for y'all is not GAAP accounting. It's actually adjusted GAAP. There is a big debate. I don't know if you know the difference between adjusted GAAP and GAAP, but we're using adjusted GAAP. If you actually go into the formula, and I'll show you the formula here a little bit when we get into the spreadsheet. I went ahead and changed to adjusted GAAP. The main reason I did that is it alleviates some of the really, really bad numbers that mess charts up. Because what adjusted GAAP does, if there's a one-time item, and everybody knows it's a one-time item, adjusted GAAP will actually take that out and move it. So adjusted GAAP is like violating the rules of GAAP, counting things as unusual items that GAAP doesn't really allow you to do that. It's a little bit more normalized. I don't know if y'all have had Cheryl, I can't remember her last name. I can't remember her name, Lysum or something. She teaches accounting here, very smart lady. I would love to have her class. I don't know if she's still teaching here. She had something come up, but she had worked for the SEC for several years, has a really good background in the SEC and how to come up with those rules. I was watching one of her accounting classes and she was extremely negative on adjusted GAAP. So there's a big disagreement on that. In the sector wars that we've done with the Investment Society, a couple of years ago, one of the judges was a portfolio manager from UTSA, and she asked why we weren't using adjusted GAAP, because she says everybody uses adjusted GAAP. So you can see there's a lot of debate, but you're using, just so you know, you're using adjusted GAAP. So if you try to tie some of these numbers back to what's in annual report for your company, you might find some of them don't tie because I'm using adjusted GAAP. So just be aware of that. It's still GAAP accounting, but it's GAAP accounting with someone's opinion on how to normalize it to take out the unusual items. So we are using GAAP. There are other accounting out there, but you don't have access to that other accounting with a few exceptions. There are some regulatory accounting. There's some of that in Bloomberg, but that doesn't really affect most of our companies. One thing I always remind students, you should carry this around in your wallet. GAAP tells us, the Financial Accounting Standing Board tells us why GAAP accounting exists. And they're very clear. GAAP accounting exists for finance. All right, so don't ever forget that. I always used to tell the auditors that. and they hated it, and they finally stopped talking to me, which was really, really good. That's one way to get rid of auditors, is remind them of why they exist. GAAP accounting is not for management. It's not for the public. It's not for the IRS. GAAP accounting, and they just tell you it's useful for investment and credit decision makers. That's us, finance. Why do we want it? And this is real key too. Number two, this is where I had my biggest debates with the auditors. The purpose of GAAP accounting is to help you forecast cash flows. Have you ever heard that before? The purpose of GAAP accounting is to forecast future cash flows. That's when with the auditors, one auditor from Pete Marek, that poor guy, he would tell me to do something accounting wise. I'm like, how in the world is that going to help someone forecast USA's cash flows? And he was like, I don't care. We're just tired of getting sued. Leave me alone. But that's the purpose of it. Now, it's also supposed to produce balance sheets, income statements, and statements of cash flows. But the purpose of all of that is to help us make investment and credit decisions and help us forecast future cash flows. So you should think about that as you're doing, especially paper 5. Your goal is to forecast an income statement and balance sheet, but ultimately is to get cash from operations and free cash flows. The forecast model I'm going to give you doesn't quite do that very well. It's a little bit summarized, but that is the ultimate goal. And how does accounting accomplish that? It's got to be relevant, it's got to be reliable, and it's got to be comparable. Relevance is that it's timely, it gives you good feedback value. So you get a new quarter's of financials, it tells you whether or not your forecast is accurate or not, allows you to check it, gives you feedback. Timeliness. Accountants have gotten much, much better at the timeliness, I think. The feedback and predictive value, I think accounting might be going the wrong direction in some places. Some of this fair value accounting, I think, is pretty messy. That's why I didn't let y'all do, one of the reasons I did not want you to do banks and insurance companies. Fair value accounting really messes up their books. Accounting is getting much better on the timeliness. When I was at UTSA, just every year, financials got done a day earlier. They were down to +3 when I finished working in accounting. They may be down to +0. They may be producing their financials the last day of the month. And it's amazing how timely. And you might think, big deal, you get the financials, +3, +4. Back in the 40s and 50s, you got quarterly financial data maybe 6, 9, 12 months later in the mail, very non-timely. So I would give accountants probably an A-, B+ on that. Reliable is that it's neutral. We're going to talk about earnings quality. You may never have really thought about earnings quality, where we're going to talk about earnings quality. I actually created a chart on earnings quality, just one chart. We could have done a lot more than just that one chart, but I created that one chart. And you'll see how you're going to interpret that chart for your paper. But we know management has a desire to cook the books at times, and they do it in certain ways that you can catch them at doing it. And so I'm going to show you one trick, one chart I'm going to show you that you can quickly see if you should be worried about management. And then if some of you in that chart have some things that are questionable, I'll also help you see how you can go do some research and figure out if it's a bad thing or not a bad thing. A good example is there's an unusual item in one company. We're looking at Medtronic. Looked like there might have been some funny business going on, but we looked at it, and they had a major sale of a subsidiary, and that caused the distortion. You looked at it, you saw the numbers, said no problem here, nothing to worry about. But we'll talk about how you can actually assess. So you want somewhere in your paper, and I'm going to show you where we're going to put it. We're going to put it right at the end of solvency, which makes sense because when firms are in financial difficulty, that's when they cook the books. So part of solvency is, hey, can we trust these numbers? Is there any funny business going on? The last one, so I'd probably give accounting maybe a C- to a D on that. I think there's some things, I like the new rules on leases. I think that makes a lot of sense. The new rules on pension accounting, I think, are good, but they don't go far enough. I don't like the new rules on fair value accounting. So, there's certain things you would think accounting would go back to the investment people and ask them what did they want. And we'll talk about some of the things accounting does that the investment profession says they need to change it. But for some reason, the accountants haven't done that. On this last one, I would give accounting a D- to an F on comparability and consistency. It might be getting better, especially I just mentioned lease accounting. So lease accounting is getting to the point that you can now compare UPS to FedEx and other companies. But it's really tough. Comparability is comparing one company to another company. And you know you have problems there, right? If someone's using FIFO or LIFO for inventory accounting, or someone's doing capital leases versus operating leases, what assumptions they have on their pension plan. Comparability is really tough. And even consistency is really, really tough. I used to, in this class, before we had Bloomberg, students had to go out and get their data from their company's annual reports. And oh, they were so frustrated because they would get their 2015 data from the 2015 annual report, and then they pull up the 2017 annual report and get 2017 and 16, and they glance over at 2015 and all the numbers were different. And it's like, what do we do? Fortunately for us, using Bloomberg, when the company changes its numbers, that's automatically updated in Bloomberg. So we have the latest numbers, but companies make changes and they go back and restate. And so it's really tough. I think accounting has some problems there. I don't think we have to do this much other than say, you know the balance sheet, right? So the balance sheet is telling you, hopefully you remember the first two words on the top of the balance sheet. You ever remember those? There's a financial statement that says for the period, and there's a financial statement that says as of, which is the balance sheet.
As of.
So the balance sheet is only right for 1 second. At 11:59:59 on December 31st, if their fiscal year is also the annual year, it's right for 1 second. 2 seconds later, it's all wrong. So the balance sheet is a snapshot in time, looking at assets, what they own, and then liabilities and owner's equity, who has the claim on those assets. And it's double book entry accounting. Everything always balances. It's a pretty magical, beautiful thing. Hopefully you remember how to do debits and credits from your first accounting class. So it's wonderful things. Where are we going to focus in? We're going to spend most of our time on the most important part, which is the current assets. We're going to talk a lot about net working capital. It's one of the most important things you've got to understand on your company. It drives a lot of things. We're going to see a very close link between liquidity and turnover, and you need to really understand that link between those two. One thing you should be able to do, so I'll test you now. You may have done this in one of your accounting classes. I'm kind of curious. They do this on the CFA exam, but if I were to give you an income statement and a balance sheet, could you produce the cash flow statement? Anyone in here think they could do that? You're given the income statement, balance sheet. Could you produce the cash flow statement?
I'm terrible at accounting.
Which class?
I said I'm terrible at accounting.
Oh,
I understand.
oh.
Yeah,
We've been doing that in the capstone.
You're doing it in capstone. Okay, that's interesting. Who's your capstone professor?
Natasha Burns.
Burns.
I also did it in Catapacum's class in Intermediate Corp.
Good. Yeah, on the CFA exam, part 1, that's a big part of the exam. I'd already figured I had it before myself because I was an accounting major. Unfortunately, they didn't ask it that year on the exam. But yeah, that's a big part. I really loved that part of the study class I took because most of the people in there had never done that before. So I could kind of sit back and say, yeah, I've done that before. It's fun to try. You should actually, one of these days, maybe during the winter break, go on the Yahoo Finance, pull in a balance sheet and income statement and see if you can recreate the cash flow statement from it. But that's the key between liquidity and turnover. It's these accounts, the accounts receivable, inventory. That's the key. The non-current assets, we are essentially just going to take them as they are. Now, that's not how they do it with the CFA exam. You do have to make decisions about goodwill. What are you going to do with goodwill? I'm not making y'all do that. Some companies, it's a huge thing. If I were you, I would look on your balance sheet and see what those intangible assets are. If you go into Yahoo Finance, you'll notice on the balance sheet for Yahoo Finance, they have what they call tangible net worth. And the tangible net worth is nothing more than them taking the net worth of the firm and subtracting out all those intangible assets. Some firms, so that's the fastest way you can check on it. Go to Yahoo Finance, bring up the balance sheet and go down to the net worth section and compare the net worth to the tangible net worth. If there's a huge difference, then this firm has some big issue with intangible assets, probably goodwill. All right, so that's a good way to check. But I'm not asking y'all to make adjustments. We will use property, plant, and equipment. somewhat in here, and we'll probably ignore the rest. Those of you doing the energy companies like Valero, they do have an issue with minority interest because a lot of them do these master partnerships. I'm not asking you to worry about that, but that in real life, you would have to spend some time on that. So there's some things we're cutting corners in this class just because it's so complicated. It won't be complicated if you work in the industry 2 or 3 years. You'll have it figured out. But for us and the time we have, we're just gonna have to let them go, all right? So that's actually good news for you. We can't get there. There's plenty of assets that firms have that they don't put on their books. Some of you will have to think about research and development costs. Exxon, Chevron, obviously, development costs, new wells, those kind of things. So they have proven reserves and, whatever their other reserves are. So that's there. No one's doing pharmaceuticals, but that's a huge one for pharmaceuticals. But think about research and development and what does the accounting say for your company. An easy way to do that is just go on their annual report and just search on research and development and see if that's a big part of their company. We talked about goodwill. So property, plant, and equipment, they're just recorded at cost minus amortized, minus depreciation, cumulative depreciation. There's no economics to it, but we really don't want to do anything else. I really don't want the accountants, I don't want the accountants at USAA trying to figure out the market value of USAA's building. Cost minus depreciation is fine with me. So we'll look at that. Some of your industry, this doesn't even matter. If you're doing Adobe or some of these, a lot of tech companies, they just don't have much property, plant, and equipment. Apple may have now because of that massive new home office they built, but some companies it's huge. So airlines, obviously property, plant, and equipment is going to be a huge issue, a huge part of your balance sheet. Liabilities, again, we're going to focus on the current liabilities, those working capital liabilities, accounts payable, and your accrued expenses. We're going to spend quite a bit of that when we talk about liquidity. The non-current liabilities, other than debt, we're going to ignore them. Now, I keep picking on airlines. Airlines have massive defined benefit liabilities and health plans. Some people say some of these companies like GM and Ford, they're just employee benefit companies that sell a few cars on the side. Their employees dominate their liabilities. So, but I'm going to have you ignore those. I did pension accounting for quite a while. I ran USA's pension plan. I learned all the pension accounting. It is the most arcane, ridiculous accounting there is. They have fixed a lot of it. In fact, they changed the accounting rules so much that USA shut its pension plan down. Our CEO so hated the new accounting rules, he actually shut our pension plan down, which really upset me because I think we had it managed in a way we could keep it open. But he shut our pension plan down. I was actually at a conference where the retired CFO of GM came up and just started cursing about the new pension accounting rules. He was so lividly mad about them, which obviously makes sense. GM had to write off $16 billion all in one day because of the new accounting rules. So some firms, this is important. And I would say if you're doing has a large kind of old school unionized labor force, I would at least look into how large their pension plan is. Look how large it is of their liabilities. If you need some help on that, let me know. Deferred taxes is a mess. I hate deferred taxes. I think the accountants, I don't know what they were smoking when they came up with these rules. It's absolutely crazy what these rules are. 2017 has an impact there, so you'll have to somewhat deal with that. The new tax law could cause some of your deferred taxes. What I did on deferred taxes is I decided that they are not a working capital liability, and so I took them out so that we don't have to mess with that. So hopefully that'll help some. Some of your firms might have warranty costs. So like Alan, I don't know if CarMax has a warranty liability. Look into that and see. I assume, they have recalls and people bringing their cars back for defects. So you might check and see how large that is. That's a big estimate as well. There's some obligations that are not in GAAP. Now be careful when I say not in GAAP, I mean they're not on the balance sheet. So what GAAP accounting says, hopefully you remember these rules, if there's less than a 50% chance of it happening, or you can't quantify it. If either one of those is true, you cannot put it on the balance sheet. So if you can quantify it, but you think it's less than 50% chance, you put it in the footnotes. If you think it has an 80% chance of happening, but you don't know how to quantify it, then you put it in the footnotes. So some of y'all might do this. None of y'all are doing tobacco companies. This is a big issue for tobacco companies when they're being sued. They knew there's a more than 50% chance that they would lose, but they had no idea how to quantify it because they didn't know what the judgment would be, especially since they were probably going to appeal it anyway. And they hated the accounting. They had to put that information in their annual report. So there are some places where reading the footnotes of your annual report, of your financial report, can actually make some sense. I'm not suggesting you go out and read all the footnotes because 90% of them are probably not important, but there may be some that are pretty important. This is one where it might be important. Litigation, any kind of recalls, or there's things that firms have to put in their annual report, annual statement, or whatever annual report that is really quite interesting. Unfortunately, you got to get through 40 pages to find it. So think about that. Off-balance sheet things, operating leases, that accounting is changing. Special purpose entities, I'm not asking y'all to worry about those, but those are things you'd be concerned about in certain industries. And then obviously owner's equity, that's the net. I try to avoid picking companies with negative net worth. I made a mistake and put one company in with negative net worth, but it's not any of the ones that you're doing. Boeing has had this problem. There was one company I think I put in that had negative net worth, and I just fixed it. I kind of massage the number back because some of your companies are buying back a lot of stock, and they're actually buying back so much of their stock it's causing their net worth to go negative. So I try to avoid those companies. So that's the balance sheet. So you can see we're going to be focusing really heavily on the current assets and liabilities because that's really where management kind of earns their keep. The flow statements, those that say for the period, are the income statement, cash flow statement, and statement of owner's equity. I do not use the statement of owner's equity at all. And it's not because it doesn't have interesting information in it. It's because everything interesting in the statement of owner's equity is also in the income statement and the statement of cash flows. So we already have it elsewhere, so we can ignore that one entirely. But the income statement, obviously, there's 4 pieces to it: revenues, expenses, gains, and losses. And this is where adjusted GAAP comes in. Revenues and expenses are supposed to be your normal operations with all the unusual stuff taken out. And gains or losses are supposed to be those one-time things. What we know over time when management argues the normalized earnings, the stuff that they throw below the lines are 90-something% of the time losses. You would think these one-time items would be 50% gains, 50% losses, but no, management tries to take the bad stuff and put it below the line. Say, hey, don't look at that. It's a one-time thing, never happen again. I mean, it's true we've had a strike every 2 years for the last 10 years, but we'll never have another strike again. So, take those numbers out. Everything's fine. So you've got to be a little bit leery of adjusted GAAP for that reason, because there is somewhat of a bias to move negative stuff below the line rather than positive stuff. So this brings up quality of earnings. What's above the line and below the line? That's that normalized earnings. Income smoothing, managements do that, though I saw that. I was on a board of a credit union, and they always wanted to smooth everything out. As soon as they had something where, do we charge 10 million or 12 million? The first question is, how good of a year are we having? Oh, we're having a really good year. Well, let's charge 12 million. We're having a good year. Let's do the larger number this year. Are we having a really bad year? I'll tell you what, let's move it into next year or whatever. So those conversations better only happen in person nowadays. They better not happen in emails because you can get in a lot of trouble, but firms still do that. They like to move stuff around, move bad stuff in when they're having a really good year, move out good stuff when having move in good stuff when having a bad year, move in bad stuff when having a good year. Because for some reason, Wall Street likes real nice, steady earnings. And so managements do that until they have a big, big bad year like 2008. When you have a year like 2008, you fire your CEO and the new CEO comes in and she takes every bad thing there is and she throws it into her first year. That way, her second year, she looks like she saved the company. So that's the big bad theory. You may be seeing some of that this year. Firms that are having a horrible year, if they got a decision to make on their pension plan, and they're trying to decide whether to use a 7% discount rate or 6%, they might say, you know what? This is the year to go to the 6% discount rate. We've been waiting to do that. We're losing so much money this year, no one's going to notice. Let's do it this year. And they just load up the year in bad stuff. So you might be seeing a bit, you wouldn't have seen a big bad theory the last 9 years, but 2008, 2020, you've probably seen some big bad there. Where does management lie? They usually lie on the accruals. That's where we're going to focus so much on those accruals. Accounts receivable, inventory. I love this book. I don't know if any of y'all have ever seen this book before. This would make a great book to put on your holiday shopping list. Yeah, tell your friends to buy this for you for your birthday or for the holidays, and they'll know you're serious about your career. It's called Financial Shenanigans. It's a great book. I actually want to show it to you, so I'm going to flip over there actually real quick because I want to show you this book. Have any of y'all read this book before? Oops. Let me do it again. All right, let me share this. Just a second. So here it is, Financial Shenanigans, written by this guy, Howard, and I don't know how to say his last name. So if you go into the, you want, let me go into, I wanted to go into the index. Well, I want to show me the index. Here's a newer edition of this item. All right, that's fine. So if you look at the index, it's really, really interesting. Hopefully, this is a new edition. It's copyright. I don't see it. It's probably in there somewhere. First, he does a great job of everything he talks about. He gives a history of it. He gives you examples, which is wonderful. So then he goes through the shenanigans, and look at what they are. I mean, they're really, really interesting here. Earnings manipulation by doing what? Recording revenues too soon. How do you record revenues too soon? We do one of two things. You either pump up your accounts receivable or you understate your unearned revenues. It's one of those two things. Well, what is that going to do? That's going to cause a huge disconnect between your cash from operations and your net income. That's why I'm saying we're going to compare those two things. When management does this one right here, you'll see a big jump in the difference between cash from operations and net income. The second one is recording bogus revenue. How do you do that? Well, one firm, what they did is they're having a bad year. They weren't hitting their targets. So they called their customers and said, if we deliver this product to you, will you hold on to it for a few weeks and then send it back to us? We'll pay for all the shipping. And so they did that. And then they counted all that as revenue. And then their customers sent it back to them a few weeks later. Well, that's illegal. You can't do that. But that's what they did. Their customers are like, why are you sending us barbecues? Well, they sent it to them so they could count it as revenue. That's a bogus revenue. Using one-time or unsustainable activities, that's that thing where it should be below the line, but you move it above the line as a positive thing. Shifting current expenses to later periods, that's that income smoothing I was talking about. Employing other techniques to hide expenses or losses. So if you think about some of the shenanigans of using special purpose entities to move all the bad stuff into those entities. Shifting current income to a later period, that's again income smoothing, but that's when you're having a good year, so you move it to a later year. Shifting future expenses to the current period, again, more income. We see a lot of income smoothing here. Cash flow statement shenanigans, shifting financing costs to operating section, moving operating cash to other sections. So it's trying to beef up that cash from operations by shifting things to investing or financing. Metrics. So he goes through each one of them. So if you're looking at that and say, well, this is a really boring book, then maybe you shouldn't be a security analyst, because this is you've got to become a forensic accountant to analyze your firm. So really cool stuff. I'm going to take all of this that he has here, and I'm going to give you one chart to talk about it. So we're not going to get into the detail he has. He used to have a company. You could go to his website and pay him a fee, and he would run your company through all of his models. And he'd come back and give you a scorecard. And he'd tell you where the red flags are. his company got bought out by someone, Morningstar or someone, so it doesn't exist anymore. So unfortunately, you can't go to his website anymore. I don't remember how much he charged. It wasn't that much. But he actually had a template that you could go through and test. Some of y'all should probably try building a template yourself on something like this. So we will talk quality of earnings, but in a very high level. But I think it's enough that you'll at least get your feet wet a little bit. So we're going to skip owner's equity statement. Let's talk about the statement of cash flows. So you have 3 sections here: cash from operations, cash for financing, cash for investing. All 3 of them are important to us. And you'll see in the liquidity section, we're going to tackle all 3 of these. The cash from operations is essentially your net income on a cash basis with one big glaring error, and that is interest expense. Where should interest expense be? In these 3 sections.
And then operations.
And where should it be? Not where is it, but where should it be?
Activities.
It should be in financing. It is in cash from operations. All right. Sometimes I adjust for that. Sometimes I don't. On the CFA exam part 1, that's one of those adjustments they always tell you to make. They tell you move interest expense from CFO down to financing activities and get rid of goodwill. Those are the 2 things they always say to do. So, so your cash from operations should not have interest expense in it. Unfortunately, there are firms that capitalize interest expense, and because of that, it's not an easy adjustment of just moving. So the interest expense on the income statement is not really on a cash basis. There's really no place you can go to get interest expense on a cash basis, so you can move it. So the best you can do is take interest expense and an accrued basis and move that from CFO, which means you'll be increasing your CFO and moving it to financing activities. I don't know why the accountants don't fix that, because that's been a complaint by the CFA Institute for 20, 30, 40, maybe 100 years, who knows, forever. But cash from operations is essentially your net income, and you might actually even want to look at some of the income statement items on a cash basis. You might want to look at cash revenues versus GAAP revenues. Now, anybody remember how to do that? Let's see how good your accounting classes did. Cash revenues equal what? Any takers on this? No takers? GAAP revenue minus what? Any takers on that? Minus. All right, I'm going to tell Elaine Sanders is one of my Facebook friends. I'm going to tell her on y'all. Change in accounts receivable. Is this coming back to you? So how do you get from the income statement and balance sheet to get to the cash flow statement? Well, revenue, cash revenues is GAAP revenues minus the change in receivables. So hopefully you've seen that before. What is cash cost of goods sold? Anybody know that one?
GAAP cost of goods sold minus accounts payable. Or change in accounts payable.
Change in inventory.
Oh, dang.
It's possible. I will give it to you to say plus change in trade payables. That's possible. Not everybody makes that last change, but yeah, you subtract. Remember. Oh, you're right. I went the wrong direction. Sorry. This is an expense. Sorry, plus and minus. So cost of goods sold is an expense, so you want to add back the change in inventory and subtract the change in trade payable, which is going to reduce your cash. So this is how you get. This is why the balance sheet and income statement together can give you the cash flow statement. It's really quite straightforward. We're going to talk about this some when we do the forecast. I'm going to show you the forecast I did for Walmart. But I'm also going to show you the forecast I did for Facebook, so you can see my Facebook forecast. I did much more detailed than this. So this is important stuff. Know how to get around the financial statements to create these kind of things. So good. I don't know who said that, but good. I'll tell Elaine Sanders you're learning stuff here. Cash for financing activity. This is where you have your dividends, your stock buybacks, your issuing of debt, and should be your interest expense. We'll definitely look at those things, especially stock buybacks. Those have been really huge here lately. So you'll see that I have an entire chart on that right there. So we'll get into that. And then investing activities, the main thing we're going to focus on there is capital expenditures. Some of your firms are doing acquisitions. We'll look at that as well. I got some charts set up on acquisitions, but we're going to really focus in on capital expenditures. All right. So there's two types of cash flow statements. There's the direct method, indirect. Almost everybody does the indirect method now. But you're going to see what I did for Facebook is I actually tried to create the direct method, because then you get the income statement items on a cash flow basis, but it's really tough to do. So I usually give up on trying it. So which is better, cash flow from operations or net income? The answer is yes. Yes, they are. They're both better. They have their purposes. So cash from operations is the easiest one to manipulate, because all you got to do is delay a cash flow by 1 day and suddenly it moves to another period of time. Accrual accounting doesn't let you do that, but accrual accounting includes a lot of estimates. And because of that, because it includes a lot of estimates, it can be manipulated somewhat. But what we want to think about, and we're going to talk about this term, a really, really important term, is free cash flow. Some of you said you had Catapacum. Catapacum is, the pro on free cash flow. There's a book I really love. I have it linked down here. You can go look for it yourself. It's not a very long book. I really highly recommend it. And they say buying stocks all comes down to free cash flow. That's all they care about. And their philosophy is free cash flow is cash flow a firm produces that they can do with whatever they want to. They can pay dividends, they can buy back stocks, they can expand the firm. It's cash flow that's free in the standpoint that management has options. There is cash from operations that is not free. So if Walmart is refurbishing its buildings, if it's fixing buildings, painting buildings, anything we call maintenance capital expenditures, it's not expansionary, that doesn't grow the business, that is not a free cash flow. So free cash flow is when management pays dividends, buys back stocks, repays debt, builds up their cash balance. You're seeing that at Apple and Google and Microsoft, large, huge cash balances. Or they're reinvesting. I don't mean reinvest just CapEx. I mean reinvest to expand capacity. So that's the key.
How could you differentiate between reinvesting in maintenance and actual growth?
Yeah, great question. So first, I've heard that some accountants have actually started distinguishing it in their financials. I have not seen it yet, but I've heard some accountants saying that. That's a little tricky because you're relying on them to do that. Or you can read my blog. So here's my blog. I'm going to ask y'all to read my blog over the week. Once you get paper 1 and 2 done, to read my blog. It's not that lengthy of a blog, although my blogs tend to be longer than most people's blogs. But what I do there is I give you an example of exactly how to do that, but for Walmart. So what I do with Walmart, if you read this blog, you'll see, is I say for Walmart, the most obvious expansion CapEx is building new stores. So what I did with Walmart is I correlated the growth in square feet to CapEx. And what I did is I found the intercept. When growth in square feet is 0, what is CapEx? Was that Alan that asked that question? Who was that asked that question?
Yeah, it was me.
Yeah, Alan. So Alan, my argument would be is if I find the intercept such that I find the CapEx for Walmart when they add 0 square feet, that should be maintenance CapEx. And then I use that formula and apply it to how many square feet they're having, and that's how I figure out the difference. And I look back at that historically and say, you know what, expansionary CapEx is about 70% of their cash from operations. So I'm going to assume 30% of CFO is not free cash flow because it's maintenance, and 70% of cash from operations is free cash flow because it can be used for expansion. Now that's Walmart. If you're doing a firm that you can't figure out what their expansionary CapEx is, it gets tough. If you're doing a Google or someone where they don't have square feet, they don't have an obvious thing, it gets a lot more difficult to do. So it's not always easy, but But I give the example in that blog of how I would do that with Walmart. But it is definitely not easy. But you want to ask the question, what is their CapEx being spent on? And that can be part of the discussion. There are some firms that I think most of what they produce, like an Apple or Microsoft, I think most of what they produce is free cash flow. I do think most of Microsoft's cash from operations is free cash flow, but not necessarily all of it. I know in Catapactum's class you get the formula. I'm okay with the formula, but the problem with that formula, it doesn't distinguish between the maintenance CapEx and the expansionary CapEx, and I think that's actually the most important thing to do. So you'll read in my blog, I do not believe free cash flow is something you go calculate off of their financial statements. I think it's something you've got to actually roll up your sleeves and actually do some pretty intense work on your company. So I'm not actually asking y'all to do this. I'm perfectly fine with you. Some of you, when we get to paper 7, we have to value your company, and your company doesn't pay dividends, you're going to have to use a free cash flow per share as a substitute for dividends. So some of you are going to have to get a free cash flow per share. But when we get to that point, I'll help you get that number. We might pull it from Bloomberg. Bloomberg has it. Bloomberg's going to calculate it very much like Catapactum calculated. So the kind of the traditional approach. But it is, in fact, Catapactum read my blog and sent me an email on one error I had in my blog, which is nice. I fixed that error. I wouldn't want to debate him in public on this issue, but I do have a slightly different opinion than him. But he's definitely the person to listen to. All right, so there's your accounting overview. So you can see there's some really important stuff we're going to have to leave kind of high level just because we don't have the time to really get into them. But let's look at what we're going to do on paper 4, financial statement analysis. We're going to be doing ratio analysis, so that's going to help us look at things across time, which is really important. We can compare firms to peers in industry. I'm actually going to encourage you to do more comparisons to industry than to just one peer. And you'll see why I think that. You can easily compare a Walmart to a Family Dollar. It doesn't matter if they're radically different sizes. You can compare 2 firms of very different sizes because they're using ratios. And rules of thumb. And here's one reason right here why I want you to use the industry charts. I'll give you very, very few rules of thumb. And the reason I'll give you so few rules of thumb is they vary dramatically industry to industry. So let's say we look at your debt to EBITDA. Say, okay, my firm's debt to EBITDA is 6, whatever it is. Is that too high or too low? Well, it depends. What industry are you in? If you're in the utility industry, you can have a really high number. If you're in a technology industry, you would have a really low number. It depends on the industry. So by comparing your company to the industry, you will create your own rules of thumb. All right, so you'll see why I do it that way. Some of the charts, you're going to see I use the term NMF, Nancy Mary Frank. That means not a meaningful figure. So when do you see that? There's a couple of times you see that. I use what we call a CAGR, compound annual growth rate. So a compound, make sure you know how to calculate this. I give you the formula here and it's in the Excel spreadsheet. However, you cannot calculate a compound annual growth rate, an annual growth rate, if you started with a negative number and ended with a positive number, or if you started with a positive number and ended with a negative number. I'm going to put NMF in there. If you got a 0, it's going to be NMF. Sometimes you're dividing by an incredibly small number, and so you'll get something like 87,000. In those cases, I'll tell you how to handle that in your charts. I'll give you some examples. A lot of times what I recommend, if that was like in 2013, I recommend you just go to that chart and just delete that one number and just take it off the chart entirely. We'll talk about that. Now, here's the key. Right here, this is the most important part. Hopefully, we don't have students that are unengaged typing their paper while I'm talking, so get engaged. This is the model we're going to use. This is paper 4 right here, number 1 and number 2, and number 3 is paper 8. So you're not going to do any of number 3 here in this paper. So you're just going to do number 1 and 2. We're going to assess your company on its short-term viability. Is your firm about to go out of business because it can't get access to cash in an emergency, or it's just insolvent? All right, so you're going to spend some time there. You'll talk about liquidity, the hardest part of the entire paper. Talk about solvency, probably the easiest part of the paper. You will have a conclusion on short-term viability. You use credit ratings to kind of test and see if you're on the right track. If you think your firm is terrible and they're rated AA, then you probably did something wrong. If you think your firm is great and they're rated single B, you probably did something wrong. Once you finish the short-term viability, you're then going to look at the long-term, and that's where the key is growth. That's going to be your focus, is growth. Remember, our whole focus is growth. Growth is not important if you're about to go out of business. Would you agree with that? Right? The firm's going to go out of business in 3 years. You don't want to spend a lot of time on how fast are they going to grow. So with Sears and JCPenney, I might stop here with number 1, A, and B, with just the viability. Are they going to be in business in 5 years? And I doubt either one of those firms. Macy's, I'd be focused on that with Macy's. All right, then we get the growth. We're going to talk top line growth and bottom line growth, activity ratios and margins. And then we'll do an ROE decomposition. You've probably done that before. You're going to find that my approach is maybe slightly different. I like my approach better than what the accountants do, and I think I'll prove to you why I want to do that. And then you'll have an overall conclusion on growth, and that's where the profitability ratios will come in. All right, so that's how we're going to work this. We're not going to get to your call today. Questions on this? This is paper 4 right here. Everything in green is paper 4. Everything in yellow is paper 8. So this is what you're going to do. So we'll start with liquidity ratios. Before we do that, I want to show you the spreadsheet, unless there's some questions. Let me show you. So you have this spreadsheet. So I added this sheet, so ignore that first sheet. So you have instructions to show you how to do this. You don't have to do it because I did it for you, so that's taken care of. I do have the Russell 3000 in here. I'll be using this to build your paper 8 because this will give me the industry for you to compare to, and I also use it for paper 4. Here's how I set up your company. Look at this page that says tickers. See line B2 and B4. Whatever you type in there, and I've already typed it for you, so you may not have to change it, but if you want to change it, this is what comes up on your graphs. All right, so if you don't like what I typed here, you can change it. Just be careful you don't use too long of a title, because if your title's too long, the second company will disappear on your graphs because it won't fit on the legend. All right, so don't do Walmart Corporation Incorporated or whatever. It just doesn't all fit. So keep it short. And here's the companies I've actually compared them to. So I actually have Amazon in there, Home Depot, Lowe's. I got a lot of companies in there. All right, here's the data I'm bringing in. On the industry. So all of this is just sets it up, and then this next page is the Bloomberg feed. You'll notice in B3, this is big formula in here. It's all zeros on mine because I'm not hooked up to Bloomberg. That's not a problem for you because we'll show what we're going to do. If you look at this formula, see if I can get into this formula. If you look in this formula, you see this word right here, FA adjusted. Can y'all see that, hopefully? Victor, can you see that? FA adjusted. That's how you know I'm using adjusted GAAP. All right? So I decided to use adjusted GAAP just because it just made the numbers a little cleaner. All right? The next page, the Bloomberg page values, is the same thing on the previous one, except for instead of a formula, I just got a number now. So I just take everything on this page when I was on the Bloomberg machine, and I just pasted it as numbers here. So everything in your spreadsheet comes off of this page. This page is really important. What that means is you better not click on row 10 and right-click and delete that row because you're going to mess up everything else. All right? Don't delete rows. Don't cut and paste. Be really careful on this page. I wouldn't touch this page if I were you. All right? The rest of the spreadsheet entirely relies on this page. All right, the next one is your print page 1. You're actually going to take print page 1 and clean it up, and you're actually going to make it the last page of your paper 4. I actually give you points for copying and pasting this and putting it in paper 4. So there's some free points right there. All you got to do is just clean it up a little bit, and I'll show you where you clean it up. Here's the CAGRs. If any of y'all have CACR, I don't know. I had that typo like 15 years ago, and I thought I fixed it. And this year in my EMBA class, they're using the same file. And some guy goes, what does CACR mean? And so it's still there somewhere. So if you have CR, change it to CAGR. It's compound annual growth rate. And you can see the formula for it. Compound annual growth rate is just 2019 divided by 2010, or for you it might be a different year. 2010 raised to the 1 divided by n minus 1. It's just the annual growth for your company. Why am I telling you that? Well, some of y'all have companies that 2010 is really messed up because you're coming out of a recession. So if you want to change that CAGR, instead of using 2010, use 2011 or 2012, you can just change the formula. Just make sure you change. If you go 2 years forward, change the 9 to a 7, change the 9 to the 7 in 2 places. So you can do your CAGR from a different year if you want to, all right? What you're going to put to paper 4 is everything down through line 51. Below line 51, we're not going to do. And I'm going to bring up one of your papers here. You'll notice below line 58, I have some stuff from y'all. Y'all see that in your paper? So the reason I'm doing that is I'm giving you some cheat notes to help you talk about net working capital requirement. I didn't do that for Walmart. I should have. I might put it in my Walmart before next class just so you can see the numbers. All right. So actually, I think this is an old Walmart. I need to bring up the actual Walmart I had. So I'm just walking you through the spreadsheet. The next page is extremely important. It's all your charts, okay? So you'll use many of these, but not all of them. So let me give you an example. So let's look at revenue per square foot, chart 9 for Walmart. I got this really nice, beautiful chart. And Costco looks great, Walmart looks terrible. Some of you are gonna look at chart 9 and you have nothing. That's because your firm doesn't have square feet. So you just ignore that chart. Maybe you're going to use revenue for PP&E. That's chart 9D. Or maybe you'll use revenue per employee. So there's different charts that you can use. But if you look off to the right, here I have chart 9B. It's revenue per square foot, but for the entire industry. I much prefer this chart to the other chart. Because if you look at this chart here, revenue per square foot, we look at that, we don't know if Costco's really good or if Walmart's just really bad, right? Looking at a chart, you can't tell. But now you look over here and walking 9B, Costco's just the best in the business. This green line is the top 10%. Costco's better than the top 10%. Walmart is actually slightly better than the median for the industry. So I prefer you use these charts, but I give you these charts for the company just in case. Now, sometimes with these charts like 9B, the 90th percentile and 10th percentile are just look ugly. They don't work at all. Like look at this chart, 6A, debt to EBITDA, where the 10% is just 0. So on that one, I might go in and select data, and I might just click off that 10th percentile and just take it out of the chart entirely. I might take the 90th percentile because it just too skews the chart. So you can make changes. What I recommend, and hopefully everybody's listening to me right here, extremely important. What I recommend you do, you see this place I have next to print page 2, I have graphs used for Walmart. What I recommend you do is add a new sheet right next to print page 2. And as you use a chart, like this chart 1, I'm going to copy it. I'm going to paste it. And what I'm going to do is, this is where I'm going to use my charts. That way, if I mess something up, I have the original chart there. And what you're going to do is you're going to edit the title, and we're going to talk about the titles. Edit the title so it explains what the chart's doing. You might change the y-axis some. So there's some things you might do to it before you put it into your paper. Just so you have, just in case something goes wrong, you always have the original chart. Okay? Also, you're going to need to renumber your charts because you're not going to be, you may not use chart 8 or whatever. So you're going to renumber them and you want them to number it in order. And so this helps you a lot. So you can see what I do with Walmart. See how I changed the title for Walmart? CFO growth volatile with anemic long-term growth. So you want to change the title. I also changed the axis. See how the axis here, the axis was so wide you could hardly even tell what was going on. So I changed the axis so I could really see the shape of it. All right, but I'll put it on a different page just so I could see that. Any questions on that? This is really important. You don't get this right, you may waste 3 or 4 hours and then figure out you did it all wrong. So it's really important how to use a spreadsheet. It's irritating to use somebody else's spreadsheet. So you're using my spreadsheet, I built it. And so you just have to, one thing I'll say right now, if you're really struggling with something and it's not working, don't waste an hour on it. Email me and say, I can't get this to work, and I'll fix it and send it back to you, okay? I can fix things in a minute that would take you 3 hours to fix. That's just the way it is when you use somebody else's spreadsheet. It's so irritating, you don't know how to set it up. I know exactly how this spreadsheet works. If you're having a problem, I'll fix it. Another thing to be really, really careful of is when you take this chart and you copy it into the Word document. Y'all probably know this better than I do, but I'm still going to make sure everybody knows this. I want to copy this chart into the Word document. Come in here and you do paste special and do it as a bitmap. Don't do it as an office graphic object, okay? You can do a snip as well. Do y'all like using snip? That's perfectly fine as well. You want it to be a picture. If you use a Microsoft object, it changes all of the fonts, it changes all the axis, it messes everything up. All right, so be real careful on that. So you paste it as a bitmap or do a snip and bring it in so it looks well. If your charts are looking really wild, one of two things happen. First, you pasted it as a graphic object, or you loaded the Excel, not in Excel, but in the Google Online Excel, whatever that thing's called. I forget what it's called. Make sure you're in Excel when you load this, or in Microsoft, Apple Excel, Macintosh. So don't open it online. You'll notice immediately if you have it open the wrong way, all the charts look wrong. They're all messed up. All right. So those are two things. Make sure you do that before you start copying and pasting, because I've had students figure that out at the end. They have to go back and redo the entire thing, all the graphs, and that can take a couple hours because there's a lot of graphs in here. All right. Again, any questions on that? So I'm going to start with liquidity in the class notes, walk through all the ratios, all the measurements. Then I'm going to flip over to Walmart and walk you through what to do with Walmart, and then you'll do that for your company. Okay, so this is going to take us a few classes to get through all of this. All right, you'll be a little more focused on Tuesday because you have your paper done and everything be really, really smoothly going. Let me just hit one issue right up front because we have a couple of minutes here. For liquidity, we are not going to use the current ratio. We don't use the current ratio in finance. I don't know anyone in finance who does use the current ratio. The current ratio is used by finance professors in universities. It's used by accounting professors, and it's used by accountants. Finance people don't. I'm going to try to convince you why we don't. I think it's a really horrible ratio. It really doesn't tell you anything about liquidity. But it's the #1 ratio that accountants use. Reason I tell you that is in the past, when I didn't use this template and I asked a finance major to do a financial analysis, this was the first ratio they gave me. And it irritated the life out of me because we don't use this ratio. All right? We also don't use debt to equity. I'll get to that one. Debt to equity's gone by the wayside. We use debt to EBITDA now. But so there's a few things you'll have to unlearn. If you put the current ratio in your paper, I'll just ignore it. But I probably won't count off or I'll probably just ignore it and not even read it at all. But I'm going to try to show you why I don't think it's a good ratio, why it doesn't measure things well. At the end of each section, I have a list of things to think about, and we'll talk about what you need. The other thing I want to show y'all here real quickly, we got a minute here, so don't leave yet. This is actually maybe the most important thing of all for today. Let me load this. I meant to load this earlier. I can find it in 2 seconds here.
You said we're changing current ratio to what again?
We're going to talk about net working capital requirement.
Okay.
We're going to use that instead, and you're going to notice that's going to be a very different look. All right, what are y'all seeing right now? Do y'all see the rubric? Or are you still seeing my?
I'm still seeing the handout.
Okay, I got to actually switch to the other Excel. All right, boy, I hate having to switch these things. All right, I will give you a rubric, a very detailed rubric on paper 4. it won't be this one. I couldn't find one for our class. This is one for another class. Y'all have one thing. The biggest difference between yours and this one is I will have one thing that just says other, and we'll see. We may not. We may or may not. I'll decide. But there's 3 things I want you to cover under liquidity. There's 3 things I want to cover under solvency, and then the quality of earnings. There's 3 things under turnover, 3 things under margin. We'll summarize growth. We'll summarize ROE. You're not going to do relative value analysis in this paper, so you can take that one out. So I will give you all the rubric. I just got to find it. For some reason, it's kind of messed up. But I'll definitely get you. You have a rubric in the paper discussion, but I have a much more. You can see this one's just really precise. It's exactly what you need. And this will follow exactly the Walmart, except for we're not going to have relative value in this one. So for relative value, I'm going to substitute for that other, where I want you to do some other things, or I'll just increase the data elsewhere. So you're going to follow this very, very, very closely. It is a very good template. I just think it's a great template. I know when I was at USA, Bob Davis came in, he followed this template almost verbatim. Not because I showed it to him, just because that was just the way he'd always learned it. He started with liquidity, then he went to solvency, then he went to margins. He did it out of order. Then he went to margins, then he went to turnover, and he radically changed USA in the process. So it's a very good template. If you started a new job in corporate or on the investment side and they just told you to analyze the company and didn't tell you anything else, if you use this template, you'd be in really good shape. So we're going to stick with it. All right, so any questions up here? I know y'all got to get off to finish up your papers. Questions on anything?
Is the paper due tomorrow at midnight or at 6?
Well, I'll put it down tomorrow for 6, but I don't count off for being late. So, turn it in when you turn it in. The only reason I say 6 is I sure hope I get at least 4 or 5 papers tomorrow by 6 so I can get started on the grading. If you're a day late or whatever, I probably won't count off for it. Your risk is I won't get them graded by next Tuesday. That's your biggest risk. The other risk is, I guess right now, being a little late is not going to hurt you too much because we haven't really got into paper 4, but you really do want to get started on paper 3, and you don't want to lose 2 or 3 days finishing up papers 1 and 2 when you need to be getting started on paper 3. So you'll have some time on paper 3 because it's going to take us a few classes to get through paper 4, but you don't want to waste that. So get them into me as quickly as you can. Remember, you can resubmit, but I'd rather, if you have one section you haven't finished, go ahead and finish it up and then submit a little bit late versus submitting it without it complete. I'd rather you submit a complete paper, even if it's a little messy, than have a whole section missing. All right, anything else?
Yes. Professor, on the Excel file, you kept saying that we have our own, correct?
Yeah, so go to the Blackboard under files for your companies. I forget what I called it. Click on that. There's an Excel file for every company that y'all chose. It looks exactly.
It's under the groups?
No, it's on Blackboard. Let me find it real quick. So you go on the Blackboard under content, find content, under live sessions, and then it says companies to select from. Do you see that?
No. So content, then companies to select from.
Companies to select from, and then it's just a list of companies.
I have Apple on here.
I added a few more companies, but it's not any of yours, so I don't think I have that. They're in there alphabetically, so you should have.
Yeah, I don't see Apple on here.
I didn't think anybody was doing Apple, but I can add Apple in there. I have Apple's data. I had one person doing Apple, and they look under added companies. You see that at the top? Yeah, click on added companies.
Oh, there it is. There it is.
Yeah, I think someone added Apple later, but I thought, well, who's doing Apple? I thought, who's this?
Joseph.
Oh, sorry. I forgot. No, it's in there. Apple is one I added later, and so it's in the added company. So, yeah, you might have to check an added company. Apple might be the only one that y'all are doing that are in the added companies. No,
Yeah,
NVIDIA is in there too. So whoever's doing NVIDIA, it's in that section as well.
Okay. Thank you. Appreciate it.
All right, sure. I'm glad you had that. I forgot I did that like that. All right. Anything else?